If you're looking to invest in a multi-family apartment building in the Greater Toronto Area, one of the first things you will hear about is the cap rate. It's short for capitalization rate and is basically a quick way to compare how much income a property is generating relative to its price. In simple terms, the cap rate tells you what kind of return you're getting if you bought the building in cash, no mortgage involved. Hi, my name is Ali. I'm the co-owner of Home and Capital Realty. We've been committed to helping clients buy, sell, and invest in real estate for over a decade. And this channel is all about educating and empowering people to make well-informed decisions, whether you're buying or selling or investing in properties. And in this video, I'm going to compare cap rate for multi-family apartment buildings in the 416 and 905 areas. Let's jump in. Now, when we talk about cap rates in the GTA, we often split it into two regions. The 416 area, that is the city of Toronto, and the 905 area, that is surrounding suburbs like Mississauga, Brampton, Vaughan, Markham, and so on. Let's start with 416. This area includes downtown Toronto, Midtown, and more central part of the city. Properties here are expensive, but rents are also strong. However, because demand is so high and inventory is tight, cap rates tend to be on the lower end, usually around 3.75 to 4.25. What that really means is if you bought a building for $2 million, you might expect to make about $75,000 to $85,000 a year in net operating income before financing. That's not a huge return, but investors are often okay with that because they believe the properties will go up in value over time, and they're buying for stability and long-term appreciation. Now, let's look at the 905. This includes cities just outside of Toronto like Mississauga, Brampton, Pickering, and so on and so forth. Properties are a little more affordable out here, and while rents are also strong, they're not quite as high as the downtown Toronto. But here's the upside. Cap rate are higher, and usually around 4.75 to 5.25. The same $2 million building in the 905 area might bring closer to 100,000 to 105,000 in net income. That's better cash flow, which can be especially attractive if you're using financing or trying to build a portfolio. So, why would somebody buy in the 416 with a lower cap rate? Usually it's because of location, tenant stability, and long-term growth. Investors know that central Toronto real estate tends to hold its value, even in market downturn. On the other hand, the 905 often attracts value-add investors, people who want to renovate units, raise rents, or improve operations to increase the building's value quickly. There's more room to force appreciation in these areas, but sometimes slightly more risky in terms of tenant turnover or property management needs. In a nutshell, 416 equals lower returns, higher prices, more stability. 905, higher returns, better cash flow, more upside, and a bit more work. All right, thanks for watching, guys. And as always, please make sure to click that like button and subscribe to the channel. We will see you in the next video.